Hey guys, welcome back to the After Hours. I'm the A-Tail Beast, and today we're going to talk about the wrap-up of 2023. Now, one of the things you have to know about 2023 is that we had a lot of retail people leave. Now, the reason they left is mostly because they lost money. Now, what they lost money on was that there was nothing to trade for a very long time. So there was a period of about 9 months where nothing was going on. Now, when we talk about nothing, we're talking about there was volume, but it was very little volume. Now, one of the things you have to understand is that in the retail market, a lot of the opportunities went down. Before, we used to see over 100 opportunities for certain gapper strategies. Now, it was somewhere around 30. Now, when we talk about these gapper strategies, we're talking about the ideal setups. We're talking about the stuff that you can find consistency. The stuff that you have been seeing, especially in 2023, is biotechnology. Now, let's break that down. So when we think about the harmony inside of the stock market, we have to understand there's brokers, there's traders, and then there's institutions. Now, with the institutions, there's the ones that are against you, and then there's the ones that just open up stocks. Now, out of these four, there's usually a harmony. Everyone wants everyone to stay forever because we all pay each other money. We give you money now, you give it back later. But there's one sector that just does not respect this harmony. That's biotech. So when we talk about these biotechs, you have to understand, inherently, they are bullish. Now, because of that, they can easily be taken by the crowd. It doesn't matter what you do. Well, the only people that actually make money inside of the biotech are usually the scalpers, because it's very easy for you to buy the bottom or buy the top or buy right before the breakout, maybe even chase the fake out. Well, at the end of the day, there's no actual consistency with biotech because inherently it does whatever it wants. But if you're a person that's a day trader and you're trying to get that 1 to 2, that 1 to 5, that 1 to 10, you're probably not going to get that far unless you get really lucky and you top take the stock. And then you can afford to wait the entire day or risk just a little bit more. But remember, we're never trying to get the top or the bottom of a stock. We just want the meat of the move. But with the biotech, it's not the move. Now, when we talk about biotechnology, we have to understand that the entire US economy, it's backed by a lot of sectors, but two of the main sectors is technology and healthcare. Now, when we look at healthcare, we understand that that's a secular trend. No matter what the economy is doing, whether it's good or bad, there's going to be a consistent amount of marketing from the healthcare sector because they have a unique structure. We do research, you fund us, even if it's fake, even if it's real, even if they do well or they do bad, they need more money. It's a consistent flow into the economy. And as a superpower, we help other people in the world. At the end of the day, biotech was really popular this year. And that's mostly because of the technology side. Remember, we went through all the hypes. We went through the hypes with EV. We went through the hypes with AI, everything related to technology. Now, when we talk about biotechnology, that's pretty much the baby of the healthcare sector and the technology sector. Now, this itself has a unique SEC filing system. When we talk about the filing system, it's really similar to healthcare. But what you have to understand is at any point, they can choose to dilute the stock in any way they choose. We understand that biotech brings in the crowd. And it's not just because there was a pump. It doesn't even have to be news. It's just the main playground for the retail crowd. But wait a minute, most of the retail crowd left last year and the year before that. So why would they be in biotech now? Well, biotechnology is mostly popular during the winter. People are concerned about their health. Now, when we look at the healthcare stock, you have to understand that they're primarily the fund research. Each company themselves might do it like 2 or 3 times a year, but when they do it big. And you would think that it'd be consistent in the way they do it. No, all the companies are different. Every ticker is different. Every person that trades a ticker is different. But normally, there's some type of pattern. This catalyst equals this price action. This float range, this market range equals this. No, at this point, biotech is completely random. So when we look at the data for biotech, you have to understand that statistically, it's not profitable in the long run. You can't do a fixed system and get a viable strategy. You can't risk 20% expecting to make 100%. There's no fixed numbers that work like this. Now, one of the things you have to understand, when we look at a pattern, it starts with the data source. With that data source, it turns into a database. That database, we run data sets using data search tools. And from those data sets, we test to see if it's a viable strategy by looking at the frequency of that pattern, how many times it shows up. And based off of how much we win and lose, we see the winning percentage of that strategy. And finally, we see a projection of those profits when we go through this entire system. we see if a strategy is viable. It starts with a data source, goes to databases, into a data set, into backtesting on those data sets, into finding the frequency of the opportunity, then finding the winning percentage of that opportunity, and then creating a projection for profit. Now, what's most important is that you have an appropriate data source. Now, the data source that we use is Spike-It. Now, Spike-It has a database search tool. So if you want to know more about that, check out the link in the description. So my New Year's resolution for 2024 is no more biotech. Now, I say that loosely because we're gonna have to trade something. When we trade as a retail trader, we're there to look for efficiency. Now, there's a lot of money in the market. You're trying to be surgical with your trades. You're trying to cut off just a little bit so that you're not noticed. At the end of the day, you can do that with a normal company where it's smooth when they do their filing system and you know where the algo is. But in biotech, it's a little different. Most of them get crowded. So if we look at 2022 and 2023, the volume was cut in half. It was even more than half at some times. Now, when you look at the biotech, you're probably seeing those massive gappers that start at a few cents, that go to $10, sometimes even $100. Well, that's not normal. When we look at things as a trader, we have to look for consistency, for our profitability. The volume is back in the market. So where did that volume go to? Well, so far, it's gone to biotech and technology. There's been a lot of biotech, but outside of those biotech, we also saw MINM and BNZI. Now, with BNZI, this is pretty much a gap up short. But if you go to the daily chart, you'll see it's a downtrending chart. Now, what this means is that this hasn't had any volume in a long time. So it's due for a spike. Usually you call it a dead cat bounce. As before it actually fully dies, it does a bounce. So the reason the stock spiked on BNZI is because they were buying something. Any acquisition brings in good press. So when we look at this type of chart, we see that it's a downtrending chart in its history. Because of that, we understand that the volume is coming from the bottom. Anyone that tried to buy this stock in the past month, they probably caught a falling knife. Because of that, we understand that the volume is coming from the bottom. With that, there's bound to be a spike because there's a lot of people that are probably trapped. And then the spike is to give them the opportunity to get out. When we look at MINM, this is a resistance play and it has layers of resistance, which makes it even more sweet of a short. Now, the closest resistance goes up to $10. Before that, it goes up to $14. Now, with these layers of resistance, we find it very attractive for risk management. When we zoom into what actually happened, this went up to like $6 and we kind of wanted it to go a little higher, but we understood it had layers of resistance. So when this goes down, it's going to come down hard and we're going to feel secure about holding our position for a long time. Meaning we'll be patient and we'll profit from the momentum in the trade, not the volatility, but the momentum. Now with this, if you held this overnight, it would have bounced back up a little bit. But again, you have layers of resistance. So you feel comfortable enough to hold it for a little bit longer because the chances of this breaking out and then continuing over the next week or something over the next few days is very low. You also had stocks like SASI. Now with SASI, this was also a resistance play. But what made this weird is that it had too much volume. Now with a crowded resistance play, it usually goes into a pushing percentage play, which is closer to a gap up short. But the risk management is just a lot harder when you have a crowded stock, especially when you're dealing with SSR or a low float and easy to borrow. It's a recipe for a short squeeze and we don't want any part of it. Now, the only one that usually profits with these biotechs are the researchers. We know this because the nature of the stock itself is very volatile. Now, if you are a scalper, maybe you can make some quick profits, but in the long term, unless you manage your risk really well, finding a viable trade signal that keeps you profitable in the long term is going to be really hard because it doesn't matter what trade signal or what catalyst or what statistic range that you're looking for inside of these stocks. It's all pretty much random, especially if the stock is crowded, a low float, and biotech. So when we talk about scalping, you have to understand that it's being very fast. It's the opposite of discipline, unless you have a specific scalping strategy. When you look at scalping, you hold things for minutes, sometimes even seconds. Now, that's the only way you can make money on biotech. If biotech has a low float, crowded stock, and it's on SSR, it's a do not trade. Now, we say this because it doesn't matter what type of topping pattern you see. The stock can gap through it. Now, that's just for the short sellers. Now, for the people going long, you might think this has the best news. They've just marketed the cure for cancer, where the volume is extremely large with 20 million or 50 million, and the market hasn't even opened. Well, you'll see that same stock go down 90% in a slow grind. There is no consistency inside of biotech. So in the past, when we look at the biotech, we would see that on average, it's always on SSR because you see some type of price action the night before in the pre-market. With that gap up in the pre-market, it usually has some type of pullback and then continues into the next day. Now, you see that gap up in the aftermarket. So SSR isn't effective yet. Now, if it's on SSR, which is short sell restriction, forget about it. Most of these low floats have a fake out or they blow right through your wrists, especially when the float is under 2 million. All right, so we're starting 2024. Time to get my crystal ball out. You're gonna have a great 2024. And that's because we're not gonna trade biotechnology. All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.